Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And with me, we have our full set of co-hosts. Ramsey, how are you?
Excellent. Great to be here.
Will, welcome.
Always a pleasure. Great to be here too.
And Mark,
I'm
always
doing
good to have
great,
you here.
Paul. Good morning.
Yeah. So, hey, with us, we have a very special guest and one who almost needs no introduction. But with that, Ramsey, do you want to set up introduce our guests and set up the topic or topics that you think we may cover here?
Sure, absolutely. So we're very lucky today to have my good friend Nick Gerhart join us. Nick has played just an enormous number of different important roles in the insurance industry over many years, working as an executive at various insurance companies, being one of the top regulators in the space, particularly with respect to annuities. I often tease him. He's one of the few people I know that read the entire ACA, all of Dodd-Frank, and the entire DOL rule. It's a lot of pages, and there's not many people that can say that. And it just speaks to the level of detail that Nick goes into when he does everything he does. And then the next piece, and we're excited to hear about it, is that Nick has been really an early adopter of all things InsurTech. Once again, with his critical eye, which has been fantastic, but he embraces the past and the future in a way that's pretty unusual in the space, and we're looking forward to a great conversation. So, with that, Nick, tell us a little bit more about what you've been up to. We're looking forward to hear it.
Yeah, I need to have you come do all my intros. That was great. I'm actually in a job transition. I just started a new job, Chief Innovation Officer at a Homesteaders Life company here in Des Moines. Spent a lot of time trying to figure out how to drive some change, innovation in a 100-plus-year-old company. And as you know, I got a lot of passion projects, Ramsey, on the side. I do investments, and Ramsey jokes, I'm the only insurance guy that tries to be an investment guy, and he's a investment guy trying to be an insurance guy. So I guess that's probably why we're such good friends. But now I'm working on a lot of cool projects. I'm on a couple of boards now too. So keeping my fingers in a lot of different things.
So talk a little bit about what you did in on the regulatory side. So look, everybody in this call knows, a lot of insurance industry executives on this call know, but there's also a ton of agents on this call, and to the extent they somehow don't know about what you did as a regulator, please share a bit with that, and then how you transitioned back into the I'll call it the buy side, back into the
exactly. You don't wake up and say I want to be an insurance commissioner. At least no normal person ever has. So when I got the call to be commissioner in 2012, I sort of said, okay, this has been an interesting challenge. I remember telling the governor I wanted to get back into healthcare, which was what I went to school for many, many years ago. And little did I know that healthcare was going to consume a lot of that job. But being a commissioner really is about looking at all the financial. It's a very technical job. I always say consumer protection really starts with the companies being able to pay the claims that they're supposed to pay. You do a lot of agent market conduct issues. I was chair of the A committee, the Life and Annuity Committee at the NAIC. So I got really involved, obviously, with life and annuity products, given that was my background as well going into that job. So I was a compliance, regulatory, transactional annuity and life insurance attorney going into my job as commissioner. So carried that through as well, and spent a lot of time with producers, agents. We put on investment seminars across the state of Iowa for seniors. We did a lot of pretty cool stuff that most folks didn't. Helped start the Global Insurance Symposium, which has really become a marquee event here in Iowa for the whole industry. And then really involved with the Global Insurance Accelerator. So I kind of did a little bit of everything, which is why the job was so much fun. But eventually, when we had our fourth child, Mama wanted to make more money. So we decided to get back into industry. And so, it was a great job. I wouldn't trade that experience for anything in the world. But it's a very taxing and demanding job. I'll just say that.
Yeah. So Nick, who could have made up to 2021? Okay. regulation, regulation, healthcare issues, financial crisis of epic proportion. I kind of look back to our podcasts. Oh, this, episode number 15. Well, long time back when we kind of rolled back, and Nick, we thought the biggest thing for this year would be, trying to understand the best interest rule, trying to understand the Secure Act. Like, whoa, new landscape, coronavirus. As you kind of think of sort of the personal financial planning landscape, where crashing interest rates meets new obligations for an agent, meets opportunities to get to actually potentially start to put annuities really in the workplace. I mean, how do you make sense of this?
Yeah.
Where are the trends? How's this going to move if I'm a practitioner?
I tell you what, for the practitioners that are out there, it's interesting. You have a lot of converging technologies that are sort of trying to displace and replace them, right? You have the robo advisors and a lot of insurtech platforms that are trying to come on and sell annuities. You've got interest rates at unbelievably historically low valuations. You got people saying that the 60-40 portfolio is dead. It should be 75-25. You've got different indices that are really hard to understand for consumers and, quite frankly, for a lot of agents. And so, but I always just start with the basics. If you're an agent out in the field, first off, customer service, be indispensable to that client. Be a subject matter expert. We're all in different spots on Zoom. Find your team of people that are going to help you to drive that value and that service to those customers. And so you're that indispensable quarterback, the glue that keeps everything together. So if you need an estate plan, I've got someone there. We could all get on one call and adjudicate your issues right in real time. And that's pretty powerful. So while it's incredibly challenging, there's unbelievable opportunities that I think are presenting themselves. And quite frankly, if you think about it, this is a show about annuities. I mean, annuities could be a really interesting replacement for that, 40% of your bond portfolio. I mean, that's how I own a couple annuities, and Ramsey knows my view of some of the indices that are out there and some of the problems around the VIX and everything else that's out there. But, I would argue that my annuities I have are probably my bond substitute. And I'm not going and buying bonds right now. I probably won't for a little while. And I know insurance companies buy bonds to back all that, but I'm still looking at that as an alternative to my bond portfolio, and with a guaranteed income kicker. I mean, so product really is at a point where it should be selling itself. I mean, people need that guaranteed income. Social Security's obviously under some immense pressure, and people don't have pensions as often. So I'm more bullish on the advisor. I don't think they're going away. I think they have to figure out how to adapt and use the technology and grow that top of the funnel. But go back to customer service 101. Call people back. I always told agents it was probably a good thing if I didn't know who you were, because that doesn't mean you're on our radar as being one of the bad guys out there. So, be one of the good people out there and just help people. And I think you can have a long career.
It's interesting with what's going on with, the COVID landscape and whatnot with people, social distancing. We've seen not only a lot of folks adapt to technology, utilizing Zoom meetings and digital platforms, but a lot of people really going back old school, if you will, going back doing telephone calls, telephone conversations for client reviews. And to your point, it's really just kind of staying in front of people, providing that value and being a good customer resource.
Yeah, absolutely. I think, especially if you're, dealing with folks that are on Zoom all day for their job, they probably don't want to be on a Zoom meeting,
Sure.
Outside of that, right? And so, no, I mean, and I've talked to some people here in Des Moines that are, in that space, and they're like, I've never had more opportunities to actually just call a client and just see how they're doing, just even just random. I mean, I had a couple of advisors email me over the week, shows, hey, just want to catch up, no agenda. And so, I mean, I think that goes a long way, just being in touch with people. But again, you got to know your craft. You have to know what you're selling. You have to believe in your value proposition. And I'm really excited about putting smart people around you so you can actually own the whole client, so to speak.
Well, Nick, we've heard that same line of thought from some of our recent guests. Exact same thing. Be a subject matter expert, bring value to the proposition, bring the right players to put the right players on the field to help your clients. With your work on fintech and what do you see over the next few years? In particular with annuities, because there's an ongoing argument that annuities are sold, not bought. And we would try to, we as a as a company and other companies have tried to kind of break that and challenge that status quo. What's your thoughts on that?
I still think they're probably more sold than bought. And the more complex they are, the harder I think it's going to be to go kind of over the top and direct to that consumer. But I know there's a lot of platforms out there that are trying to crack that nut. And I think it really is going to start with kind of, I always say we spend so much time trying to segment customers into, okay, he's a white guy, he's 45, he's this. And what we need, what do people love and what do they hate? People are going to love the fact that, these products offer guaranteed lifetime income, right? And so whoever can figure out a way to find that group of people online and kind of micro target them and be able to offer that value prop, and more importantly, education. I know some of the stuff Ramsey's worked on with Alex FYI is pretty interesting. I mean, that's sort of really top of the funnel work to get that education going. Because you're right, most people aren't going to wake up in the morning and say, hey, I need more life insurance, or I got to buy an annuity to shore up my retirement income. People, no normal person thinks like that. And so you have to put it in terms they understand. And I think some of these platforms, some of the robo-advisors, a few other platforms that are emerging are trying to sell annuities. Maybe they work, maybe they don't. I think the cost of acquisition almost too high for some of those platforms. So they got to figure out a way to monetize it and bring that cost of acquisition down, because if a agent can deliver clients cheaper, that's going to work all day long. And really where I think it's going to go is you're going to see agents, develop processes to rope that technology into their practice. I think you're going to see much more of a convergence of the agent becoming more productive, using the technology for those that want. I think of it much more as a no wrong door. Any door should be open to that customer, and we just got to make sure there's someone on the other end of them to receive them and help them. So if I were an agent, I'd be looking at these tools as more additive, not competitive, and how do I use the ones that make sense for my practice is what I would be doing.
Yeah, well, clearly, Nick, we've seen, Mark and I've seen our own business, how quickly the market has adapted. And I think in a lot of ways, clients have adapted to this environment more quickly. Mark and I were on a Zoom client appreciation event we set up for one of our agents. Mark, I think what the average age may have been like 81 or something on the Zoom call.
It was up there for sure. Yeah,
it was astonishing. We have live chat on our site, Nick. I happen to be now a licensed agent in 47 states, so I can sit and talk to these people to see who comes through. I've been chatting with 80-year-olds at 10 o'clock at night on it's behaviors change. I totally agree with you, though. I don't believe that you can just be better than the next person at buying Facebook and Google ads and think that this is going to, pull people into to buy your product.
No, I mean, you got to offer value, and everything's going to start online. So, as simple as having good reviews out on Google and all these things. I mean, if you don't have kind of that first good impression digitally, then you're going to have a hard time. And then it's, what do you have that's going to educate me and help me? And I always tell advisors, if you can get 100 raving fans, you're going to have a great practice, because they'll do the marketing for you. So, you don't need to boil the ocean and have 5,000 customers out of the gate. If you get 50 to 100 in a few years, you're going to have a great practice. So, take care of the people that are there and build off of that.
Yeah,
Nick, we all want to ask you questions. So if anyone wants to go first, but I wanted to touch on the Secure Act at some point.
Yeah, I was just going to, along the same thread as we were talking about annuities being, more sold than bought in the environment today. It's interesting. I think there's still a very common misunderstanding out there about the value that they bring. I was at a dinner party over the weekend, and there was an individual there that was probably in his 70s, asking what I did for a living. And I said I was involved in the insurance business and I was in the distribution of annuities. And his comment was, "Oh, annuities." And I said, more about that.
Stay back.
He didn't really know why he didn't like them, and as we talk more about it, he's like, "Oh, I didn't realize that they did that." And I think that's a big part of why, we're seeing that they're, still much more sold than bought. And I think it's still a big educational curve that needs to be overcome in terms of getting a better understanding out there.
Well, I don't like him because Ken Fisher said I shouldn't. I mean, or somebody else,
Right.
Mr. Fisher. But yeah, I mean, somebody said I shouldn't like them, so I don't like them. And people don't understand sort of the incentives that other people have. And so I always say the products aren't good or bad products. They're good for the right people. They're bad for so it's all based on the needs of the consumer. And if you're 35 years old and aren't looking at these future obligations, and maybe you don't need one. But if you're, in your 50s and you're starting to think about my, lifetime income and running out of money and having something that they make a lot of sense. So it really is about the needs-based selling approach.
No doubt.
So can I touch on the Secure Act, Nick? So, and Paul mentioned this, we kind of came out of the gate in 2020 with a focus on a variety of different things, low interest rates and Secure Act and, changes there. And, a lot happened, which, and we've all been addressing all the changes that have occurred this year. But going back to the Secure Act, do you have a take or your opinion on how realistic or likely we'll start to see annuities being an option for retirement plans, 401ks, et cetera? And how do you think that will look as we progress in that direction?
Yeah, obviously the problem before the Secure Act was always the fiduciary obligations under ERISA, and the fact that the people felt like they had to pick the best one. And when I was at American Equity many years ago, we actually got one of their annuities in the 401k plan, and we went through a very laborious suitability test to get comfortable with it, and effectively made an annuity available to employees. It was not available to anybody else. And anyway, long story short, but I believe, when I left there was significant money going into that product out of people's 401k, cash. And so I think if you can get into those plans, they make a lot of sense. I think there's, again, some education, and I think having the regulatory relief that I'm not going to be held as liable under ERISA for violation, but we got to work through portability issues. And I think that's pretty simple anymore with today's technology too. The last thing you want to do is build up all these mortality credits and then just cash it out. I mean, you want to be able to hopefully carry that with you wherever you go. And so there's some of those issues. I'm not sure we've figured those out yet, but I think that people would like them a lot, and having that predictable retirement income is a good value proposition. But again, you got to realize there's a lot of people that are pretty, Ramsey's big guy in passive investment. A lot of people want to just kind of put in an S&P 500 fund and forget about it. And so, it's I think it might be more of a consumer issue once we get past the regulatory issues, that people see that as an opportunity for them to invest some of their retirement dollars. But I think it's a big.
I agree with you. I think there's there'll be a pent up demand. There already is for an income stream for those that don't have pensions. So it's intriguing and of interest to us, obviously, as it is to everyone.
Yeah, Nick, if you're on the carrier side, now you clearly were on American Equity, had to saw what you know what it takes to put a product out to market, design it, file it, put it out, and then hope somebody actually buys this thing. If you're a carrier and you're thinking about where do I put my resources? From a planning perspective, is this a 2-year, 3-year, 4-year, 5-year, march for a company to actually get meaningful sales through a 401k at this point? Or is this something that's going to start happening next year?
Nah, it's probably, before you get a good run rate, it's probably a couple, 3 years, Paul. I mean, I don't think you're going to have anybody in market with huge sales numbers, even probably 2021. And I think it's much more around, getting into those 401k plans, but then you have to be, the advisors that run the plans have to coach the people up, and the employers have to understand it and offer that value prop. And, I'm always amazed at the number of people that still don't even contribute to a 401k plan when there's an employer match. And so, I mean, there's just, people are going to put off tomorrow as long as they can. They don't want to really think about it. And quite frankly, the industry hasn't done a very good job of positioning the product the right way for people to understand the value in that longer term. So I think we have to do a better job. But quite frankly, the advisors that are running these plans, if they're not going to be supportive of it, then when they're talking to their plan participants, they're not going to position it well either. So, I think it'll be one of these deals where it's probably 3 to 5 years you could get to a good run rate that money's going into them, and hopefully by then the interest rate environment gets a little better, so we can have a little bit more value in the product too.
So I've got a question on that. I agree with you. Between the infrastructure being set up to actually offer those products on the platform, and then consumers getting around to it, it's hard to see it not taking a while. I think one mildly controversial question is maybe it should be opt out. Maybe the default should be an allocation from payroll into these plans, and where the default funds in a deferred income annuity, and that the consumer has to opt out. There's some academic work that supports that, nudge, et cetera. I was curious what your thought is on that.
Kind of as a free market guy, I always hate it when you make me do something, but I think this, from a behavioral economics, I mean, it's pretty well proven out that, if you make people sort of pull that trigger and actually leave the plan and are automatically in it, that works pretty well. And people kind of adjust to that new cash flow position. They don't even miss the money after their first few checks. So I think as a society, it's probably good public policy to say, yeah, that you should be automatically in these plans. And especially if you're under the age of 30, I mean, that's really the group that could really benefit the most. And those small dollars really can add up to large amounts over time. And so, I always had to stand back, when I got my first quote real job, the first thing I did was sign up and put 10-15% in, and, because my wife and I are nerds like that. And, but I've come to realize we're kind of the outlier, and so I think having that nudge and the more studied behavioral economics, I think that's a good nudge for people. And I don't think anyone will argue with you 10-15 years down the road because they'll see the real numbers there, Ramsey, but they might bitch a lot the first few months.
I guess
get out of it too, right? I mean, yeah, and get out if they don't want it. So,
one thing that always surprises me is the disconnect that people have as it relates to what an asset will generate in income, making that conversion. And I think one of the provisions in the Secure Act in terms of outlining that on an annual statement, will likely help people, number one, realize that better, but number two, hopefully contribute more, and do a higher participation. What are your thoughts on that?
Yeah, I mean, I think that's great. I always tell the story when people say that they don't think, the dollars add up and they matter. My wife and I, when we were had our first child, we had one of these credit cards that puts 2% of our purchases into a 529 account, and then we set up a state one too. And that little account, obviously, I spent way too much money, but I got $36,000 in that account, and that's just that's going to be used for her college in addition to. So I think that the more you can get people to understand that, Mark, the better. And that just adds up. And now you're like, okay, 15 years later, I've got almost 40 grand sitting there that I wouldn't have had in any other way. And so you tell people like, hey, imagine if you hit 200 a month, and imagine what this starts to look like down the road. And so if we can't get people to understand their future self, it's really hard, because it's always easier to spend the money today and kind of think, okay, everything will work out down the road. And so I think, I don't think you're going to meet a 55 or 60-year-old that's going to regret the money they put aside when they're in their 20s, right? And, and that's why some of those campaigns we had a while ago, they were kind of, hey, envision your future self and kind of, saw yourself a little bit older. That was interesting, because I think it's really hard for a 25, 30-year-old to think like that. I'm 45. It's hard for me to even think about 75. So I mean, you start to think about those things. And one thing I've always heard is, well, I'm not going to live that long. And then you talk to someone who's in their 70s and say, well, man, if I would have known I was going to live this long, I wouldn't have done all the stupid stuff when I was younger. Like, well, there you go. So I think everyone's got to just understand that, chances of your longevity is a much bigger risk now than, kind of premature death. And if you're not starting to insure against that longevity tail risk, that's going to be your biggest risk, I believe, certainly for anybody that's under 50 today. It's much more of a longevity story than a premature death mortality story. And we've got to look at products that sort of meet all of these needs. And I wrote an article a while ago about we did a kind of a rebirth of the industry and some newer products that meet that demand. But I'm pretty bullish on the industry, though.
Well, maybe if we can flip to and spend some time, talking about exactly that, Nick, the future here, where the future may take us. I guess, look, you were there with Brian, setting up the global insurance accelerator, first insurance accelerator. Now, we've got a lot.
Yeah.
What's going to happen with the InsurTech, the whole InsurTech? What will InsurTech look like, 2 and 3 years from now? Same players actually getting momentum? Will we see winnowing out, maybe a whole new type of, set of companies emerging?
Yeah, well, I think Ramsey are going to create a tontine. No, I was kidding. I don't want to get into tontines, Ramsey. But no, in all seriousness,
Don't be afraid.
exactly. No, well, I think what we're going to see, you'll see a winnowing of the herd, right? You're going to see a lot of firms that realize that they had a good idea, a good product, but not a good business, right? You're starting to see that now. You're going to see a lot of players that are going to, what I call, do the integration in, and they're going to be service providers to the industry, trying to kind of make those old incumbents, kind of more digitally aware and more relevant to the consumers of today. And then you're going to see sort of the MGA full stack group, and that's really where I think it'll be interesting to see if some of these full stack carriers move the needle. In 10 years, I don't know if you look at the tables 10 years from now, you'll see one of those players in the top 10. I'd be a little surprised, but it's possible. I think the ones that are going to probably do the best are the ones that are really either distribution facing, so they're top of the funnel, trying to help with client acquisition, and those that are really looking at data and trying to help the carriers become more digitally aware. I think that's where I'm see the most opportunity if I were looking at the insurtech space. I think starting a carriers, it's really hard. It's not really good use of capital, to be honest with you. The returns aren't very good. So every time I hear someone say, "Oh, well, we're going to go, for an Apple like venture here," and you look at some of these numbers, the multiples are nuts. But the business itself doesn't support that sort of a return, as you well know. You price a product hoping to make 6 to 8% if you're lucky. In most lines, in some lines, you're hoping to make 4 or 5. And so, I think we'll see the real thinning of the herd, but I'm most excited about the people that are integrating in, looking at opportunities there that would help my company and others become much more better at acquisition, use of data, trying to help move that customer experience to a better human experience too.
Nick, do you view the regulatory landscape as evolving like simultaneously as we see this innovation coming from companies?
When I was commissioner, I was probably the first one to really push the envelope on that and realize that the coming evolution of technology and insurtech was really going to move the industry ahead, and that a lot of regulations really weren't up to speed. And so I think commissioners and regulators have come a long way. I think that they're really understanding that there is opportunity to serve customers better with these tools. I think the biggest issue we're going to face, obviously cyber, but it's data access, ownership, who owns the data, what can I do with the data, value-added services versus rebating, those sorts of debates. I don't say debacles, but debates. So what is a value-added service? What's a rebate? And I think you're going to see carriers evolve into more ecosystem plays where they're looking for partnerships. Aetna just announced an industry deal with Apple, and so you're starting to see these sorts of deals emerge all over the place. John Hancock Vitality. There's all sorts of examples all over where carriers have partnered either with an insurtech firm or an old tech firm and trying to drive that. And regulators, I think, kind of have a dual mandate. One is consumer protection, the other is financial solvency. I kind of argue they're both the same a little bit, but at the end of the day, they want to be flexible. They don't want to be in the way of innovation and customer changing demands and needs. So it might take longer than some of the startup folks want it to happen, but I've seen a lot of progress, I'd say, the last 2 or 3 years for sure.
One of the things that I've been thinking a lot about recently is, what's the right funding model for insurtech? And up until now, a lot of that funding has come from venture capitalists, and that model requires a really super fast growth rate that results either in great success or failure, and it's meant to happen very quickly. And I sometimes wonder, as I've sort of gone through my journey, whether maybe a private equity model, sort of a buy and build model, might be more appropriate. I don't know if you have an opinion on that, but I'm very curious to hear if you have any, having had your hands in it for so long. What do you think is the right way to support this innovation from a funding perspective?
No, I think the private equity model, I never really thought of it that way, but that's interesting, sort of the buy and build. The other thing I think's probably going to be happening much more is the whole, the strategic investment, side of it too, where the carriers, take an investment in something and it's a product they end up using and help build. I've seen a lot of carriers do that with some success, which you could argue is a little bit like a private equity kind of model in some respects. The venture side of it, I don't think it's going to go away anytime soon because there's just so much capital sitting out there, and I'm not even that dialed into some of the new deal flow, and I had 3 calls this week for people saying, "Hey, I've got this new idea, and I'm going to." And it's just like, and they're all cool ideas, but it's really hard to see a path to revenue, and so. I think the private equity model could work really well, to be honest with you. The venture folks, they get so many deals on their desks. I was talking to somebody a few weeks ago, and he's like, I don't even know where to sort these things out. He's getting so many that are coming at him. So, and I think if I were a founder, I'd look much more for the permanent capital, family office kind of stuff, or the right venture firm could really work. But I like the private equity model if I was a founder, quite frankly, and wouldn't mind the carrier route either, getting some stable, because really what you want as a founder is that runway, so you're not on that proverbial, wheel that you're always raising capital. And so your job as a founder is never to actually work on the product and drive it forward. It's raising money and raise money and raise more money. That's a tough spot to be for a founder.
Yeah, it's Nick, it's a fascinating topic here. We've got an incubator in Hartford and trying to match some of these starts with funding, and it is a chicken or the egg. The VC's got the money. They have the appetite for risk to a point. They kind of want the guaranteed deal that will generate a 5x return in 3 years, or now 10x in 10 years type model. And you've got to be you've got to have a lot of companies locked into contracts with you to get there. Private equity is a little, they're more used to dealing with, they want to deal with like 7 or 8 numbers on it.
Yep.
Right? Not like this.
Mm-hmm.
You go to, angel investors will write, they'll write $20,000, $30,000 checks, because, you need more than that if you're really going to, build one of these products.
Yep.
And how do you get to that $1 million? How do you get this, go from angel funding to getting $1 million in revenue? I think there are a lot of companies, kind of startups, stuck in that no man's land.
Oh, absolutely. I mean, and that's a lot of the firms I've either put money in a little bit or helped out along the ways. I've always said there's that tipping point, right, where you're going to look like an overnight success, but it took you 5 years to get to that point, and you're grinding it out the whole way and all that, and you probably almost went out of business 3 times, and no, I think you're right, and that's really where I try to steer folks to, you got to find the right model that makes sense for you as the founder, and realize that if you pick the wrong partners, you just bought yourself a really crappy job. You know what I mean? So you're now working with people that be really hard to work with, and so that whole process. Well, I haven't gone through it as a founder. Obviously, it's fascinating to watch, because and then you got the guys and gals that just realize, well, I got to take any money I can get, and that doesn't work out very well for them either usually. So I think that if you've got the right product, right model, and you can prove it out, the money's there. Then you got to figure out, okay, well, what do I want out of this deal? And am I trying to build a business, or am I trying to build something to flip? Because those are 2 different things, right? And so, if you're really looking for something to build and sell to Apple or Google or somebody else, big firm, then the venture makes all sense in the world, and they can make sense the other side of it too. But you just got to make sure it's the right fit, I think, for that founder. And because the ones I've seen that aren't a good fit, that's really where the problems come, and no one likes it, and it never works out well.
Yeah, one insight that I heard from some people at Y Combinator that really stuck with me was that advice to startups was don't get in love with your solution, love the problem you're working on. If you were to look at sort of the annuity and retirement space and say, in your mind, what's the if I'm a startup out there, what's the biggest problem I could focus on and try to solve here over the next 3 to 5 years? Is it customer demand? Is it this legacy, supporting the carriers?
We don't have a Steve Jobs of pensions, right? So we don't have that person yet. And so, no, I think the problems really do come down to the customer understanding the value proposition. The products, even with all the creative indices and everything that's in them, they're pretty much haven't changed since 1995 when the first index annuity was sold, and VAs, but the products themselves are pretty well. Could you come up with a new one? Could you figure out a way to get out of the regulatory trap and come up with a true pooled product, that's really mortality based, like a Tontine. That would be pretty groundbreaking and something I'd love to be a part of. But I don't. There's just so many hurdles there. So I wouldn't spend a lot of my time there if I was a founder. I think I'd focus much more on how can I drive that top of the funnel where I get people inside of it. They understand the value of it. They understand that this, and really for the customer experience, how do I get it so it's much more akin to buying a product I normally buy and not a house. I mean, we've, and again, a lot of that has to happen. I was a regulator. I probably caused some of the problems there, but the harder it is to purchase, the worse off. And then can you solve for other tough problems in these products? I'm working with a group that's working on some really cool long-term care stuff. Can you look at a true hybrid product that's innovative, creative, and actually solves that long-term care conundrum that some of these folks are in? Don't even realize they're in it. So I think I'd focus on sort of those sort of things and come up with the right value prop those customers really need. Because if you solve for the problem, you're absolutely right. Who knows how the hell you're going to get there? But if you can fix long-term care, if you can fix longevity risk, you'll make a lot of money and you'll help people do what's right for them.
Yeah, Nick, I couldn't agree with you more on this whole topic of longevity. It seems like, I don't know, there's a vast gulf there between what people understand what their potential needs can be, and that there is available products in the marketplace that can help solve those needs. So there's a divide that I think it needs to be bridged to a certain extent. I know we're coming up at the end of the time, but I couldn't help myself but jump in on annuities and talk to and just get your very brief high level opinion of this landscape between 187 BI, the new DOL rule, and the new updated NAIC model reg. I mean, there's so many, it's such a dynamic landscape for an agent to kind of navigate depending on what state they're in and who's adopting and if they're registered, and so what's your thoughts on that? How to best navigate that landscape that's changing so rapidly?
No, I mean, it really is difficult. And if you think about I keep it kind of simple. Start with taking care of consumers, start with a need-based selling approach. Document why are they there, and if you think about the job of the regulator, it's kind of like, a data scientist looks for the problems on the outliers. Regulators do the same thing. They're not, most people, if they're doing right by their customers, they're going to be fine. And yeah, you got to go through the process. You've got to sign all this, but you don't have to pick the best annuity product. You got to fit, a good one that meets their needs and be able to stand behind that. You have to be able to show why you made that recommendation and why it was, in their best interest, or why it made sense for them, why it was suitable, kind of suitable 2.0 on the NAIC side. But regulators, they're people too, and they don't have all the time in the world, and so they have to prioritize the work they're doing as well. And I always told agents, if I didn't know you as commissioner, that was probably a good thing. It means you're doing things at least well enough where I don't have to know you, which is good. But I think we spend so much time worrying about all of this, and it should, because it's really important. But if you really just understand that you're trying to do the best by the customer, I think you're going to be fine. Got to fill out the right forms and sign everything you need to sign, and have the customer sign it and explain it to them. But I've been in these shoes of an advisor where I've kind of come in to help people with a quote bad sale. And I remember firsthand walking out of that house, and by the time I was out of their driveway, the customer called me and says, "We talked about this." I was like, "No, that's not what we talked about." And so, I think even having things with it's recorded, and when I was doing estate planning, having other family members there if they're elderly, for sure. Just having kid gloves with certain situations. And sometimes, the sale ain't worth it. If the person doesn't understand it, or they're being too complex and argumentative, or they're elderly, or or they just had a tragic thing happen, like a spouse died a few months ago, don't make that sale. I mean, some of that stuff is it's better to walk away from some stuff than to take them all on. And because, somebody else will sit there. But if you're doing your job and you're educating people and you're available, and newsflash, happy customers don't complain to regulators. So, if people are happy, they're not going to complain. So again, the people that complain are the ones that you don't call back, the ones that you ripped off. You took 80% of some lady's money and put it in an annuity. I mean, those are the ones that, and unfortunately, those are the ones everyone hears about, which makes Ken Fisher and other people hate annuities, right? So I don't know, pretty simple, but just do it right and you'll probably be fine.
Hey, well, listen, Nick, thanks so much for your time. Mark, Ramsey, any final thoughts, questions?
No, I think this is great. Nick, thank you very much, man. I think your closing comments is if you do it right, you do the right thing for the client, that's the main objective. That's what's going to make the sale, make it make sense. So I think that's always the number one thing to keep in mind.
Absolutely.
Yeah.
Go ahead, Ramsey.
Words to the wise. So thank you for sharing your wisdom today. And to your point, I think there's just great opportunity for advisors to leverage technology and to provide better service for their clients. So thank you for sharing.
Yeah, you bet.
Yeah, and by the way, for those of you watching the video, Ramsey is not in his normal studio. He's actually in a car. And Nick, little do you know, he is actually outside your house. We're going to put you in the car, and we're going to switch the show into annuity karaoke. Okay, so
he's going to sell me an annuity, exactly.
So hey, listen, Nick, thanks so much. Really appreciate having your show. Mark, Will, Ramsey, thanks. And for all of your listeners, like us, subscribe to us, give us feedback, tell us who you'd like to have on the show. And we appreciate all the comments, and support you've given us. So till next time.
Thanks again, Nick.
Next week,
Appreciate it.
For another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.